Did you know global financial markets are no longer reacting to single headlines, but to a slow accumulation of signals that suggest the world economy is entering a more uncertain phase? Today's market movements reflect that reality, as investors across the globe reassessed economic direction rather than reacting to any single event. Stock markets opened cautiously this morning as traders digested a mix of inflation data, central bank commentary, and corporate earnings guidance. In the United States, major indices moved sideways for much of the session, signaling hesitation rather than confidence. Technology stocks showed relative strength, while interest rate-sensitive sectors such as real estate, utilities, and banking faced renewed pressure. Bond markets provided one of the clearest signals of investor sentiment. Treasury yields edged higher as traders recalibrated expectations around interest rate cuts. While inflation has eased from its peak, policymakers continue to warn that price stability is not yet guaranteed. The market wants reassurance that inflation is beaten. What it's getting instead is patience from central banks. That patience is creating tension. Investors had hoped for swift rate relief, as borrowing costs weigh on corporate investment and consumer spending. Instead, central banks are signaling that policy decisions will remain data-driven and cautious. Globally, European markets closed lower, reflecting similar concerns. Manufacturing activity remains weak in several economies, while consumer confidence surveys show households pulling back on discretionary spending. In Asia, markets were mixed as exporters balanced currency movements against slowing global demand. Corporate leaders are also signaling caution. Earnings calls this week revealed a consistent theme. Companies are prioritizing efficiency, delaying major capital expenditures, and preparing for slower growth scenarios. We're planning for stability, not acceleration. For everyday consumers, these market dynamics have tangible consequences. Mortgage rates remain elevated, credit card interest continues to climb, and borrowing remains expensive for small businesses. Economists emphasize that this is not a crisis moment, but a transition period. Growth is slowing, not collapsing. Employment remains strong, but wage gains are moderating. The question is whether the economy can cool without stalling. Investors are now looking ahead to upcoming inflation reports, employment data, and consumer spending numbers. Any deviation from expectations could trigger sharper market moves. As markets navigate this delicate balance, one thing is clear: volatility may remain the norm rather than the exception.